Zoe Maleti, and welcome to yet another episode of Money Matters. As you by now know, Money Matters is an interactive show that aims to educate our viewers on their consumer rights and provide money-related matter advice. Do you perhaps have a money-related issue that you would like us to weigh in on? Please do not hesitate to contact us on the details as they appear on your screen right now. On today's topic, we are talking planning, but in particular, planning for your child's tertiary education. How far are you? Have you started planning for your child's education? And I think it's quite an important topic and discussion that we should be having because it's part of what we have to pay for being parents, right? We have to make sure that we have got these things better done. And must I tell you that today joining us in studio is Ashley Paulus. Welcome, Ashley, who is a financial planner. Ash, can you please tell us a bit about yourself and what you do?
Yes, absolutely. So I've been a financial planner for close to a decade now. I'm currently partnered with A2, which is a franchise under Discovery. And I assist clients with holistic financial planning, looking at wealth preservation, wealth creation, and all the likes.
Wealth preservation and wealth creations, underline that. And that's what we're going to be touching on quite briefly today. So Ashley, I know we're talking about planning, right, in general as a holistic topic.
Yeah.
But more so, we want to zoom into saving up for your child's education. Perhaps can you just, tell us why it's so important that we actually feature our child's tertiary education as part of our normal, as part of our financial planning?
Yes, absolutely. So education planning forms part of your longer term wealth creation strategy in your financial planning. And it's absolutely crucial. I mean, if we look at the likes of inflation, salary increases which don't stay up to date with inflation, by you planning for your child's education, you can make use of compound interest and therefore alleviating the problem coming or the concern coming of paying for that in the future.
For paying for that in the future, it's quite interesting that you brought up the inflation bit, because that's exactly what we're seeing right now, right? Playing out in that education has become so expensive. Maybe perhaps we say private schooling has become so expensive.
Yeah.
So how do we navigate, particularly maybe from your client base, right, to the trying to balance the fact that if your client comes in and they've got home loans, they've got, home insurance, what's this financing? They've got vehicle financing, they've got all these other sorts of financing. And when interest rates go up, we do understand that obviously all those buckets increase.
Absolutely.
But now you also have this fixed component that is your child's schooling, right, that you currently have to pay for.
Yeah.
How do you balance some of those elements up, taking into account that obviously you might have not necessarily saved up, say, for your child's normal, primary high school education, but perhaps only focused on the tertiary education? How do you balance the immediate?
So the answer lies a lot within overall and holistic financial planning. You mentioned the debt aspect. When you're sitting with a financial planner taking you through these aspects, one would isolate debt first, because debt is the biggest killer to our growth in financial planning.
Correct.
You can't save properly for retirement if you've got too much debt. You can't save for your kids' education. And also, so isolating the debt factor first and tackling that. And then looking at your other important aspects of your financial planning as the parent, as mom and dad or husband and wife, looking at risk planning and your investment planning, specifically retirement.
Yeah.
And then looking at the education planning. And all of these aspects need to be reviewed on a regular basis. So looking at them overall and then utilizing the products that the South African legislation forms part for us to benefit from in terms of tax rebates and whatever it may be.
Yeah. I actually like the fact that you brought into the picture, the holistic approach to it, and that if I'm a parent, I can't just focus on my child's tertiary education and savings or, saving for that at the detriment of my retirement savings.
Yeah.
Can you tell me why that it's important that we actually strike that balance?
Absolutely. So the biggest thing we see, we love our kids.
Yeah, today.
If we try and understand the Father's heart towards us as his children,
correct,
we only understand an inch of that.
Exactly.
And we love our kids dearly. But what we tend to do is we shift our focus to something that is not wise. In the sense, and I say that in the sense of we focus on education planning, but we neglect our retirement planning. And in doing so, we continue the cycle of me then reaching retirement and my son's maybe an engineer, but I don't have retirement planning. Whose problem do I become?
Child's problem.
Either government, which is unsustainable financially for me as the recipient, or I need to lean on my kids. And we want to, through good financial planning, you want to break that cycle and help people make wiser decisions. Education, don't misunderstand me, education planning is crucial, but not at the detriment of what we also need to be looking for as well. That's why holistic approach is the right.
The balanced approach. And what I'm hearing from you is that if things do get tough, we need to look at alternatives, right? You might currently, as a viewer sitting at home, or one of our viewers sitting at home, they might be financially overstretched. It's a new term that I've heard recently. Someone might be financially overstretched, right? And maybe they're trying to find ways of alleviating some of those pressures. And what I'm hearing is that it shouldn't, if you need to remove your child from a certain school, you shouldn't think twice about it if it's to balance things out in your home environment. So, and that's quite important for me, because often I find that, especially, and I'm going to mention people in our community, right, as Black people, middle class, is that I have my child in this elite school, and there's the pressure that I've created, internal pressure, mind you, that I've created for myself, and this expectation that I've created out there, a perception that I've created out there, that then makes some of my financial decisions a bit difficult, because then I can't make the right decisions because I'm afraid of the perception that is out there. But what we are trying to say here today is that we need to balance those elements up, right? I can't then, at the expense of, say, either my health or at the expense of my long-term investment plan, take away from that to supplement here, then end up being a burden on my child.
Absolutely.
At a later stage. So because it's part of this holistic wealth creation as a family, right? You're trying to make sure that as you sustain my little family, make sure that you create enough for your child to not start from zero or minus, to actually start from somewhere, so that they can leave something for their kids to start from something. That's how we grow generational wealth. So that's what I'm hearing, which is quite interesting. Kids start from grade R. Right. And in an average school, if they started grade R, say in 2016, right, and they are set to matriculate in 2028, the total cost is about just, in the upper 250s on average, right, for that total schooling. And I'm sure probably this figure does not take into account inflation and so there's so many other things that come into play. How do I then make sure that can I save up for my child's tertiary education before paying for this particular bill, or can I actually save up for the current schooling together with the tertiary education schooling? Can I invest for that, or do I need to buy a risk product for that? And what are the differences and the nuances between a savings product and a risk product for education?
Absolutely. So one can follow both approach, and that falls into the foundational principles of financial planning of wealth preservation and wealth creation. Wealth preservation is to ensure that, God forbid something happens, a risk event, my wealth is preserved. Something as silly as my vehicle needs to be insured, because if it's stolen, I'm losing wealth technically. It's an asset, right? Now, saving is then for longer term. And to answer your question, one can most definitely save for grade R.
For longer term.
For longer term, you can save for primary school, high school, and tertiary all in one. And you just start liquidating or using them at certain intervals.
Correct.
And then just keep saving,
Correct. And obviously, I can't start saving for grade R when my child is 5. Because then they're going to have to go to grade R next year. That's a bit short term. So I need to have planned this by the time my child, when my child was born, I needed to have, sat with a financial plan and made sure that we actually planned this out. But I want us to really focus on the distinction between a savings product and an insurance product, because sometimes I find that we tend to misconstrue some of these concepts. And sometimes I think I'm actually taking a savings product, whereas I'm taking a risk product, right? What are some of the nuances? Because a risk product, there's a certain event that is linked, what risk are you covering, right? And so we need to be able to try and clarify those differences, those distinct differences between the two products. We, with the savings product, can exit at any stage, but the risk one, there's a certain event that needs to take place. Can we just try and make this distinct,
Absolutely.
comparison between the two?
Sure. So just to go back to what you did mention before I tackle that question is on the burden of education planning is if we don't plan for it early enough, the likelihood of it being a burden is even higher. So, I mean, if our little one's 5 years old and we want to plan for grade R, the burden is going to be higher. The time span is shorter, so we need to save more.
Correct.
On the risk and investment type products, so absolutely, risk is a product similar to short-term insurance. Is if you're not paying the premium, the benefit ceases. There's no fund value. So if you cancel the product, in most generic terms, unless certain insurers do offer some other benefits, but it's not an investment product, you can't get access to it. And that specifically is linked to one of three events. God forbid the insured, let's say myself, passes away, becomes disabled or severely ill. And that then triggers a benefit that pays either government schooling or private schooling.
So there is a risk event that is attached to a trust that you have insured. And so that's quite a distinct product, a distinction that we have to make. So now there are various savings options that are available to me as a parent, all right? And we talk unit trusts, we talk, which is pooled funding, and there are various other products. Can you just give us examples of some of those that, our viewers can utilize at home?
Yes, absolutely. So we've got two sectors. We can use the investment sector or the financial services sector in the insurance companies, or you can utilize the bank. For longer term savings, I always advise that we consider an investment platform or a financial services company like an insurer. And we can look at products like your tax-free savings account, which massive benefits long term, unit trusts, where tax efficiency is not as much as a tax-free savings. And then we can look at an endowment, which is typically, it's a fancy word, but for the investment that's stuck for 5 years.
Correct.
So when you start it matures after 5 years.
You fix it, pretty much. So there's a bit of fixing that happens there.
That's right.
Thank you, Ashley. We need to take a short break. And to our viewers at home, please do continue this topic with us. Do continue engaging with us. Don't forget to tag us. It is #MM on SID on our various social media platforms. But for now, we'll see you just after this. Welcome back, everyone. You are still tuned into Money Matters, and before the ad break, we were talking planning, but more so planning for your child's tertiary education. Please don't forget that you are part of this conversation. Continue your discussions and engagements with us on our social media platforms using the #MM on SID. Ashley, back to you. I think before the ad break, we started delving into the various products that we can utilize as part of our savings plan, right? We spoke about tax-free savings accounts, we spoke about unit trusts and endowment policies. Can we maybe just delve a bit into each of those products?
Yeah.
And perhaps let's just focus on, are there distinct differences between those and the likes?
Absolutely. So if we start with a unit trust first with your collective investment scheme, so that is basically a bank account type structure where you have access to it. It's not locked in. There's no penalties. That's the nice thing about a unit trust, right? The other benefit about a unit trust is that it's taxed on your normal tax rates depending on what underlying assets that is. Now, that's just a fancy term of where the fund managers invest their funds. Is it in equity, cash, or bonds, or the likes? Unit trusts are relatively accessible. So if you give notice to a unit trust manager or to your product, with a few days, 3 to 10 days maximum, you have your withdrawal amount back with you, no lock-in periods. Similarly, on a tax-free savings account, a tax-free savings account is a unit trust structure, but it's got a tax-free component which is set out in legislation. And how that works is every individual is allowed one tax-free savings account or multiple ones, but within one limit.
There's a limit, correct? There's an annual limit, or a lifetime limit, actually.
Correct. So lifetime limit per investor is 500,000. meaning that you're not allowed to contribute more than 500,000 in your lifetime. But then it's brought down to an annual limit to say the current legislation says 36,000.
36,000 rand, yeah.
Correct.
Yeah.
If you do contribute, this is a word of caution, if you do contribute over that limit, you do
You're gonna
get
get
penalized. Penalized, yeah. So we don't want to over contribute.
Yeah.
So if you're looking at maximizing your 500,000 limit, it's going to take you between, I think, 15 to 18 years, somewhere in that time frame. So this then becomes a long-term investment.
Investment, yeah.
Correct. If you do contribute 36 for the year and you withdraw 20, you don't get the 20 back. You've used that limit, so now you've withdrawn the funds. So use a tax-free savings, not as an emergency fund, but a long-term.
Correct. So tax-free, long-term.
Correct.
Okay.
And all the growth on the tax-free is then
It's
obviously
tax-free.
tax-free.
That's the benefit.
Absolutely. So that's the benefit on the tax-free. And in,
Can I just, maybe whilst we're talking on that, and I think
Yeah.
also a word of caution maybe to our viewers at home and for our parents who might want to open tax-free savings accounts for their kids.
yes,
I think word of caution is that even your child has got a lifetime limit. So if you utilize, if you eat into their 500K limit, just know that you need to make them aware that you've actually utilized a bit or a portion of their lifetime sort of limit for the planning or for the saving. So rather, if you are going to use it towards their long-term saving, as opposed to part of your plans, but utilizing your child's threshold.
So let's say a family, mom, dad, and 2 kiddies. You
Yeah.
can have 4 tax-free savings,
Yeah.
1 in each of their names.
One each of
That's what you're mentioning, but you're going to be using that individual's limit. So given that you're happy with that, and when they come to the age of understanding, is to say, this is what we've done and why we've done it. Just also bear in mind, legislation does change. We don't know what will
what's going to
change,
happen. Correct.
but you don't want to use up their limit and they won't then be happy with it, which would hamper them from planning for their own thing.
Especially if you're going to withdraw from it, right?
Exactly.
So I think if
That's
you are going to use it, just make sure that it's for their benefit and for their benefit alone. So that's quite interesting. But I think also it's just, I think as the people start unpacking the various products, it's important that you actually do, that they actually do see a financial planner so that they understand how the products are comprised. Because you mentioned things like there are certain underlying instruments that actually sit in that pooled, unit trust. And so understanding that you can't be very, depending on your risk appetite, there's so many things that need to be assessed.
Absolutely.
So that you can have the right product matched to your profile, because it takes into account your age and. So I think it's quite important that our viewers are aware of that. And then we also spoke about endowments. Let's just talk a bit and unpack, what some of those elements are.
Okay, so off of face value, your endowments, if we have to categorize them and just isolate tax efficiency, tax-free savings account the most tax-efficient vehicle for education planning, unit trust second, and endowment last.
Okay.
Endowments are taxed at a flat rate of 30%. So if you as an individual are not paying SARS a tax rate of more than 30%, you're technically losing without you knowing it in the back end, just because of the high tax rate.
It's actually quite high. I wasn't even aware that it was that high.
So it's taxed, flat 30%.
It's quite high.
And the other thing with an endowment is it doesn't cater for a short-term savings goal. Let's say you're saving for the next 3 years for your child's education, whether it be partial or fully. An endowment is locked in for 5 years.
Yeah, you have.
You can make one withdrawal, but there's penalties
There's
involved.
penalties involved.
So we wouldn't want to go that route with an endowment, and that's why the most important aspect is to sit with a financial planner and explaining these things and which product is going to suit your need and your objective at the end of the day.
I actually made a mistake when my child was born, right? We took out an endowment. I was none the wiser at that point. We took out an endowment. I promise you that thing did not grow in value. I think when we had to withdraw it at the end of the 5-year period, I felt like I had just taken that money and put it under a mattress. That's how, frustrated I was. But I think it's quite an important aspect that we need to bring in, that it's important that we actually understand how these products work and what they are and what value we're getting out of them, so that you can get the most value out of the products that you're using for your child's education.
Absolutely. If I can just touch on that, Troy, in terms of investments, they're so complex.
Yeah.
Right? And for the viewers, an investment is generally comprised of 3 categories, if you want to explain it like that. It's who's the administrator,
Okay.
what is the product, and what is the portfolio.
Yeah.
The administrator doesn't necessarily matter. It could be the likes of an investment platform or an insurance company, anyone
matter.
out there, right? Those are the guys whose name's on the statement when they send you the statement. They do the administration.
Yeah.
Then the product is, what is the product? Is it a tax-free savings account, a retirement annuity, an endowment? And that's not where your growth comes from, but that's where your tax benefits come from.
Yeah.
Like the rebate with the retirement annuity or the tax-free savings for the likes of education. And then your growth mostly, 90% of it, 95% of it lies within what portfolio is it?
Portfolio is correct.
Is it conservative? Is it moderate? Is it aggressive? And we've got thousands of portfolios to choose from across the likes of every investment platform in the country, even offshore. And that's where the growth lies.
Yeah. And I think maybe just for the benefit of our viewers, when we're talking about the portfolio construction, we're talking either the construction of the portfolio itself might be the funds are sitting, maybe in a cash, like a money market, and they could be also in equities, they could be property within that portfolio that actually makes up that what we refer to as the portfolio.
Correct.
Right?
Correct.
So the portfolio is like little bits and pieces of, instruments that actually make up that portfolio. So it's quite important that we understand that you don't necessarily then go and pick a portfolio that is more, risk averse, that is where a bulk of your money is sitting in a money market. Well, today you'd be happy. But where a bulk of your money is actually sitting in a money market, but you want to strike that balance where you have a bit of equity, where you have, some of that money invested in money market instruments and some in offshore instruments, as you've mentioned. So it's quite important that you understand the composition of that portfolio and what the various instruments, are in that portfolio. So it's quite interesting. And then we spoke about, briefly that there are certain risk products, right? Initially that we spoke about where you've got, say, your life cover, where you've got your life insured, right? Under that policy, I'm the parent, and so I've got myself as the insured, right? And some of those products do actually come with the education benefit or the education fund, as part of that product. Let's just unpack a bit about that particular product, where it's got like an education protection element attached to it.
Absolutely. So most insurers in the market today have developed this product, and it's quite a nifty little product. So what it does is it's an additional benefit that ties to your main life policy, right? And you can then choose how you want to structure it. You can then say, all right, God forbid I pass away, education is taken care of. Or you can choose all three risk events, saying a death, disability, or severe illness. God forbid either of those three occur, education is taken care of. Then we go a step further and say, am I planning for normal public schooling or private schooling? And generally the product then takes care of the insured's little one, the minor, up until the age of 24, where we then finish up school in South Africa. God forbid the risk event was triggered. And then we've got 6 years to complete a degree, if you want, in South African universities. And some of them have even got benefits with like Ivy League schools in New York, where you can go and utilize at that front as well.
You can actually access from that front as well. But again, there's a cost element depending on what you choose, like you said. So if that product has got like a private education schooling, just know that you're going to pay more now towards that product. And if it's a public schooling, then just know there's obviously like a give and take depending on what you're taking from it. I just want us to then maybe just to zoom into what government actually offers in this space. Right. So there's something called the Fundisa Education Savings Product. What is that?
Okay, cool. So this is actually such an awesome thing. It's a collaboration between public and private to take care of households that earn less than 180,000 Rand per annum. So if for any of the viewers that fall into this categories, if you're bringing in 15,000 Rand or less per annum or per month into your household, you can qualify to invest in the Fundisa fund. Now, that is linked with various insurers and banks as well, so you can approach your bank to find out if they do have a Fundisa fund. And what they cater for is strong capital preservation. Because if we look on the other front, when we invest for ourselves, capital preservation is not guaranteed. We're bearing the risk. Where with the Fundisa fund is to take care of education with capital preservation. And how it works is you open up the account with a lump sum contribution of 40 Rand.
40 Rand.
40 Rand. And then you've got to maintain a 40 Rand's minimum premium per month. Okay. It then grows within the investment fund with the strong capital preservation goal, right? And then every year you get a 25% bonus over and above the growth that the fund has got, up to a maximum of 600 Rand. Okay. Which says that if you're contributing 200 Rand, 25% of that for the annum would be the 600. You can contribute a bit more, but that just helps those lower income households to also cater partially or fully for education.
It's about that's about R1.50 a day that you have to save to actually get to, around approximately 40 Rand a month, which I think it's something that our viewers can actually look into.
Absolutely.
And we have no excuses, and everyone can actually try and save for their kids' education, right?
Absolutely.
Everyone can actually try. And I think it's a brilliant concept by government and private sector.
And just even on the beauty of compound interest, of looking at the numbers, I mean, if you're saving 100 Rand a month, right, for 18 years, your money's doubled up, right? Half of that fund that you come out with at the end of 18 years is just compound interest. It's not your own money. And the other half is your contribution. And the higher you accelerate your contribution, let's say you take it from 100 Rand to 200 Rand, the fund value will be even bigger and the compound component even more. So make use of the compound component.
Make use of the compound component. I think we'll leave it at that, Ashley. Thank you so much for being part of this conversation, for joining us, and for all the tips and, the education that you've actually brought with you onto the show and for our viewers and for the benefit of our viewers at home. I think it's actually been an eye-opener for me. The Fundisa Fund has to be the highlight because then it means that everyone can actually have access and everyone can participate in making sure that we do something towards our child's education and actually take for advantage of the eighth wonder, which is compound interest, eighth wonder of the year. But thank you so much, and God bless you. And to our viewers at home, and there you have it. We've actually come to the end of our conversation today, and I hope that you learned a lot, as much as I did, on this topic as we unpacked the various products that are available for you to suit even your budget needs and requirements. But do continue this conversation with us, again, utilizing the screens, the details rather, as they appear on your screen right now. But from me, Joy Manute, and the rest of the Money Matters team, it is goodbye and God bless.